Hey, good morning. Let's continue talking about retirement planning. And remember, I have a very strong philosophy on this. You either plan or you don't plan. Most stuff we suffer consequences or we enjoy the benefits. Those are consequences as well, but good ones. Okay, so what's the what's the makeup of all this? What kind of containers do these things go in? Well, the most well known is IRA. That means you have an individual retirement account. I'm not talking about eligibility here. I'm talking about what vehicles are available to you. I call them containers a moment ago, but that's what we're talking about, vehicles to carry this thing through. 401 is probably as big a name as IRA. Then you see that a lot in corporations. Then there's 457 if you're in the public sector, like working for the state. Then you get private business. So private business has actually even more options because they might do a pension plan where pensions are in the federal arena and the state arena, but they're pretty much fading in corporate America. But a private business might decide they want a pension plan. And the reason is very simple. They put money in and it guarantees an income on the other side. Whereas if a private business starts a 401, there's no guarantee at all on that thing. It's just going to end up wherever it ends up. And we, the consumers, get to choose what type of investments are in there. So we're leaving a lot of stuff up to ourselves, aren't we? Picking and choosing among all the different stocks and bonds and cash accounts out there. Okay, but still the container, the vehicle, is a 401. Now we're in the private business arena. Then they might get into, or you might get into something called a simple IRA. And it just expands how much you can put in because you include the employees. And you might match the money they put in with a certain percentage of their income. A popular number is 3%. If they put in 3% of their income, you would put 3 beside it. It's found money for them, but it also promotes some savings. It's a great benefit. Then we get down to the individual retirement account. But while we're talking about, these are qualified plans, which means IRS has to approve them, and they do. Then you can get really fancy out there. There's something called restricted property trust. That's high-level tax deductions. That's what's driving that. But you've got something called the 412E3. This is a pension plan, and it's designed, and be alert now to this, it's designed for the smaller business, maybe 5 people or under, and the owner, typically in this arrangement, is much older. Employees younger. You might think of an old retiring dentist, and then he's got a support staff that's maybe in their 30s and he's 68. So these type things, I'm not saying that qualifies him, I'm just saying that that's where you use this. And then you have what's called non-qualified, which means we don't have to ask IRS anything. We just save some money up, for gosh sakes. You just find a bucket and start throwing some money in it and then decide how you're going to invest it with cash, bonds, real estate, stocks, gold, silver, whatever. And we're going to discuss how to really set up whether it's qualified, which means IRS is approved, or non-qualified, the investment options that should be in a retirement plan. I'm going to show you how to really line this thing up, and it works. Okay.